Hello, everybody. Welcome to Clever Investments. Please don't forget to subscribe if you don't want to miss the weekly update. This time, let's share a topic that can save you lots of money. It's called tax harvesting. And tax harvesting can save you capital gain tax. But we first need to understand the wash sale rule. Okay, assume you are holding some stock index and somehow it's a bear market, index drops a lot. If you close a position, you could take a capital loss. And this capital loss in the future can save you lots of money by offsetting your capital gains. So maybe you would think that what if you close the position, get the capital loss, and immediately open the position again, so that you're still in the market, except you have capital loss for your tax benefit. Well, that's not allowed because IRS has this wash sale rule. So it said if you sell something and if you buy something substantially identical within 61 days, basically 30 days before or 30 days after the sale transaction, the close transaction. In that case, it triggers the wash sale rule, where you are not allowed to take the capital loss. So you keep your cost basis, or your new position's cost basis will be increased by this capital loss, but you cannot use it. So what is substantially identical? If you have an ETF that invests in S&P 500, and then you sell it, you buy another mutual fund that also invests in S&P 500, that's substantially identical. And also, if you sell some stock or stock index, and your wife or your husband buy the same kind of or substantially identical security in your spouse account, it's also trigger the wash sale rule. Or if you have a company that's controlled by you or by your spouse, and that's also counted. So if you sell something and your company buy substantially identical stuff, security, it also triggers the wash sale rule. And because capital loss is not allowed in wash sale, so we don't want to trigger wash sale, but we still want to do tax harvesting to save the tax. So here are the steps that I used to do the tax harvesting. So the first step is I need to turn off automatic dividend investing of the security I want to sell. And I need to turn this off in all my brokerage accounts. Because if I don't, at the end of each quarter, new dividend comes in and it will automatically buy that stock or stock index. And if that fall within the 30-day window or 60-day window before or after the date you close your position, it triggers the wash sale rule. So usually it's not a problem, not a big problem, because the amount of dividend is often much smaller than the amount of the shares you are closing. But once wash sale rule is triggered, reporting it on the tax form is very tedious. So you don't want to do that. So the easiest is to simply turn off automatic dividend investing. Next, you want to make sure you never bought it in the last 30 calendar days. So calendar days include weekends and holidays. So if you bought it, then it will trigger wash sale and cause you trouble. So make sure you never bought anything in the last 30 days, or never bought the same kind of security in the last 30 days. And then you can pick the lots of the security that are already having a higher cost basis than today's price, and then you can sell it. So any brokerage allow you to pick which slot of the stock you want to sell. So pick those with the highest cost basis. That give you the most amount of loss. And once you pick the lot, you can sell it, you get the capital loss. And right after you sell that, you can buy another security of the same dollar amount on the same day. So for me, if I sell Nasdaq 100 or QQQ, I would buy VOO, which is S&P 500, because I believe in the rough trend of these two broad market index should be fine. And if I feel that I have too few QQQ and too much VOO, then after 30 days, I can sell some VOO and buy QQQ. Or for my case, since I have new money to invest, then when I have new money, I can invest on QQQ instead of VOO. So I use VOO and QQQ as two securities that they are similar, but they are not substantially identical. And that cannot trigger the wash sale rule. And for you, if you pick two other indexes, that's of course also okay. And then you mark it on your calendar and make sure for the next 30 days, do not buy similar security, or do not buy its options, stock options of this security. And after 30 days, you can turn on the automatic dividend investing. So you only need to do this when there is a big bear market, because otherwise the stock index you're buying goes up in general. So all your positions are having a capital gain, not capital loss. But when you do that in a bear market, you kept similar position in the stock market, but you already get some capital loss that can save you some tax, which is very important. And if you pay for some financial advisor, they charge you a high fee. And the most important service they can do for you is also tax harvesting. So by doing this yourself, you don't need to pay the financial advisor hefty fee, which often in the range of from 0.5% to 1% or sometimes even more. Okay, so that's all for today. See you next time. Thank you.